the measures that we are seeing, they are continuously increasing packages which are still being reviewed. There are a number of lobby groups that are also pushing for additional cushioning of taxes. I know the KBA, Kenya Bankers of Association, has put in a proposal to lobby the Kenya Revenue Authority to waive any penalties on late payment of taxes, obviously because of the impact on liquidity of a number of institutions, just to bring out certain packages that would cushion the taxpayer. So moving on to the next slide, which touches quite a bit on the GDP, and this is specifically to Kenya in terms of what I mentioned before. So GDP reported for the year 2019, 5.4%. Projection for 2020, this is based on the Kenya National Bureau of Statistics. For 2020 was projected to grow to 6.4%. In 2021, 6.1%, and 2022, 6.3%. So on to the next or other economic indicators which I would like to touch on. The other main economic indicator that we like to monitor and look at is the inflation rate. So inflation rate has largely been stable because of the improved weather conditions. And the expectation from the Central Bank of Kenya is that the inflation of the country would be contained between 2.5% and 7.5%. So currently with the disruption in the supply chain, there would be some pressure on inflation. We also have the effects of the locust, which has not yet been felt, but this is likely to have pressure on the inflation rate. Currently, with the reduced prices on oil, that is both diesel and petrol, this is likely to cushion the inflation rate in terms of lower cost of fuel. However, because of the measures that have been put in place on the pandemic, that is to ensure that we maintain social distancing, where the matatu operators have been required to reduce the capacity of people they carry. The prices of transport has gone up. So in spite of the reduction in fuel, prices have gone up within that sector. And also just to ensure that they are able to meet some level of revenues because of the limited operating hours which are in place. Because of the curfews, there have been some rises in the cost of transportation, which has an impact on the inflation rate. So our estimate for this is that we still will be able to contain inflation below 10%, despite the disruption on the supply chain, and also in terms of the high prices of certain commodities. Now, in terms of the interest rates, the first one I would like to touch on is on the interest rates relating to credit. The Central Bank of Kenya, in its last Monetary Policy Committee meeting, reduced the central bank rate from 7.25% to 7%. And following the repeal of the interest rate cap, it is only facilities that were under the interest rate cap regime that are impacted by the review of the central bank rate, which means that anytime the central bank rate is adjusted, banks are required to automatically or immediately adjust the interest rates for clients who had taken facilities prior to the repeal of this interest rate cap law. However, this also pushes banks to also lower their rates. So in a way, it also provides for cheaper rates for the other facilities that are taken post repeal of the interest rate cap. On the interest rates relating to investment in government securities, these are expected to remain largely stable. There has been heightened demand for shorter term securities as opposed to the longer term securities because of the uncertainty caused by the current environment. So these rates are largely stable based on where they were as at end of April. 91-day at 7.2%, 182-day paper at 8.1%, and the one-year paper at 9%. So the Central Bank of Kenya is ensuring that these rates remain low so that they ensure that they maintain the cost of borrowing, since the government also does borrowing through these instruments in the domestic market. So they would like to ensure that they do not price this expensively, which would then have a negative impact on the economy. In terms of the interbank rates, these are largely expected to remain within 5%. So on average, this has been between 3 and 4%. Currently, there is quite a bit of liquidity in the market because of a slowdown in economic activity. And also the fact that the central bank has also put in place a number of packages that has ensured banks remain liquid. Unfortunately, also in terms of the credit outlay, a number of banks are a bit more cautious with their lending at this point in time. So in terms of the extension of credit, that may have slowed down, especially after the pandemic. So there is quite a bit of liquidity which is still available in the market. So the interbank rates will continue to remain stable for this particular point in time. So next, going to foreign exchange rates, we have seen the Kenya shilling take quite a beating. As at end of April, we closed that month with a rate of 107.3 to the dollar. If you remember, in 2019, we closed the year at 101.3, and it was projected that the Kenya shilling would remain stable in 2020. However, because one of them is the diaspora remittances, which have been supporting the foreign exchange reserves that we currently have. So because of the global economic impact, the diaspora who are working abroad, some of them are not able to work currently because their jobs have been impacted. So the disposable income they have has significantly declined. A number have come home, so they are not currently working abroad. So their source of income abroad in terms of what they have available to send home has also declined. What is supporting the Kenya shilling currently is the reduced demand for oil. Oil represents a big part of what we import as a country. So in terms of our foreign exchange demand, in terms of what we use the greenback for. So because of that reduction, that has then supported the Kenya shilling to some extent. Some of the sources of our dollar earnings is from tourism. We know tourism has also taken a big hit on this impact. So that has also reduced our earnings and also contributed to the pressure on the Kenya shilling. So moving to the next slide, this touches on the sectorial impact analysis in terms of the key sectors that we have. So looking at what contributes to the gross domestic product, our highest contributor is the agricultural sector, which contributes currently 18.3% of the total gross domestic product. So we have all the other sectors: mining, manufacturing, construction, transport, financial services, education, and the others. Now, based on our own assessment, some of the sectors which are likely to be highly impacted currently and going forward is the accommodation and restaurant sector. On a mild case, we expect the contribution of this to reduce from the current 16.6% to about 7.1%. In a moderate case, this will be a reduction of 2.0%, that is negative growth, and in the adverse, negative of 10%. We saw the CS for Health in terms of his attempt to revive the accommodation and restaurant sector, where he partially allowed reopening of some of the hotels and restaurants. But obviously that didn't go too well. And the cost of meeting the requirements for resumption of operations are a bit too punitive for this sector to basically operate and make some good returns within this sector. Some of the sectors that are expected to demonstrate some growth is the health sector, where currently all focus is on PPEs as well as other health equipment, everything that is needed to deal with this pandemic. So there's quite a high demand within this sector in terms of meeting some of those essential equipment to be able to deal with this pandemic. So our projection is currently, if you look at the contribution within this sector, is 1.8% of our GDP. We expect this on our best case to be 6.7%, so a growth from 1.8 to 6.7%. Now, still on this slide, I wanted to touch on in terms of the imports and exports that the country makes. So in total, and obviously Kenya is a net importer. So based on the statistics that I have, the total imports that Kenya makes is on average around $17.1 billion. The exports account for only about 6.17 billion US dollars. Now, looking at the countries or continents that we import from, 65% of our imports come from Asia. Out of this, about 23% is directly from China, 16% from Europe, 12% from Africa, and 4.9% of our imports come from North America. Now, in terms of the exports, we export 34% to Africa. Out of the total exports, 28% goes to Europe, 27% goes to Asia, 9.8% goes to North America. Now, looking at this in terms of some of the products that we do import from these countries, I believe there is now an opportunity for us to be able now to source some of these locally or to meet the demand locally. So just looking at, for example, the opportunity to still be able to export to countries like Uganda, where we export 8.2% of the total exports that we make outside of the country. Tanzania, 3.8%. I read recently a joint meeting between the heads of states of the East African community, where they have agreed to ensure that the trade lines are open in terms of being able to continue to carry cross-border trade within these countries. So thank you very much for listening to me. I will hand it over to Beth to take us to the next session. In case there is any question around this, I'll be happy to respond to this. Thank you very much. Over to you, Beth.
So thank you, Davis, for helping us understand our landscape, especially from a micro and macro perspective. I will spend a few minutes just to apply a gender lens to the impact of the health crisis. And as you all know, the COVID pandemic has created and is continuing to create a profound shock worldwide with different implications both for men and women. And so as we all know, the spread of COVID is not just a public health crisis. It's also an economic crisis, quickly becoming a financial crisis. So women face compounding burdens. They're overrepresented working in health systems. There's unpaid care work in households. They face high risk of economic insecurity. They face increased risk of violence, exploitation, abuse, and harassment during times of crisis and quarantine. Now, due to the persistent gender inequalities and across many dimensions, women's jobs, businesses, income, and wider living standards actually may be more exposed than men to the anticipated widespread economic fallout from the crisis. Now, financial inclusion for women has been challenging in developing markets where women entrepreneurs have lower access to capital, which severely restricts their progress and ability to contribute to national economies. So despite women being risk averse, women-oriented businesses may be at a much higher risk of closing despite periods of zero revenue. And which is why my submission is that the policy responses must be immediate and they must account for women's concerns. Now, there's an image that I have shared in the next slide, which basically is a graphical representation of what is happening to entrepreneurs, both men and women. And the question here then being, how do we manage cash flow in this season? Now, allow me to share some general thoughts. Now, in an unprecedented crisis, there are no pre-cooked answers. That's the first thing. And the second thing is that you have to remind yourself and others that we do not understand the situation. I often say we have to be comfortable in our vulnerability of not knowing or understanding the situation accurately. The third point here, and as a general thought, is that you have to activate the best process that you can. So you have to assess the situation you're in and figure out what is the best process that you can. Later on in the presentation, I will share some thoughts of the processes that can be activated. Another thought here is that this outbreak has been able to result in major cash flow challenges for the small and mid-sized companies that have seen businesses dry up as normal economic comes to a standstill. Now, many small businesses, restaurants, bars, gyms, florists, salons, they've been forced to shutter amid government-declared lockdown, while others have seen customer demand plummet as people isolate at home to avoid social contact. So really the immediate challenge here for companies is actually not income, is that cash flow is simply not there. And as we all know, cash flow is the lifeline and the bloodline of business. So when liquidity disappears, what happens? I will want Davis to come in once again, just to give good background of the discussion around what liquidity is, the structure of a typical cash flow statement, and key liquidity ratios. And then thereafter, I will move on to my comments and recommendations as to how to manage cash flows. So Davis, kindly come in and take us through the discussions around the cash flows.
Thank you, Beth. So now I'll get straight into it. So in terms of looking at a cash flow statement, so if I go through it step by step in terms of what comprises the cash flow statement. So the first thing you will have is you will start with your opening liquidity position. So what is your current opening liquidity position, let's say at the beginning of your financial year? Now, there are a number of activities that drive your liquidity. One is you have operating activities. Here you have things like your receivables and your payables, and you'll have things like taxes, things that are part of your business operations. Now, the next activity that you will have is, or rather your source of cash flow is either cash flow from investing activities. Here you're looking at cash flow that comes from dividends in terms of shares that you may have invested in, or if you're an entity that is publicly quoted, there are dividends that you would also be expected to pay out. Investing activities also includes things like purchase of property. You could also be selling any assets where you'll be getting cash flow into the business. The other activity is financing activities. And here financing activities include things like bank loans. So in terms of getting cash flow, you may want to speak to your banker to give you a loan, which means there will be some cash inflow. When you're making payments, interest payments, these represent cash outflows. If you are partnering or getting some equity injection, this will also be a source of cash flow to your business. Now, once you add all that together, you will then, at the end of all this, get your ending liquidity position. Now, before I hand it back to Beth, I thought it would be important also to touch on some of the ratios that businesses or the finance people within organizations look at in terms of assessing the liquidity position of an institution. These are also some of the ratios that your financiers or some of your suppliers or creditors will be looking at just to be able to gauge whether you are liquid or not. So there are numerous ratios, but I'd like to touch on two ratios. And specifically, these ratios are used to measure the ability of your institution to meet short-term debt obligations. So the first one I'll touch on is a ratio that is called acid test ratio or quick ratio. Yeah, so this ratio evaluates how quickly you are able to convert your liquid assets into cash to be able to meet or to be able to pay your short-term liabilities. Now, this looks at your cash. Some of your assets here will include cash. It will include accounts receivable as well as marketable securities. So these are securities that you'd be able to convert into cash as quickly as possible. So if I give an example, if you have a fixed deposit today with a bank that represents asset on your side, which is earning you interest, you are in a position to break off this fixed deposit contract with the bank to be able to convert that with cash. If you have investment in government securities, especially the short-term paper, either 91-day, 182-day paper, these you are able to quickly convert into cash, either through sale in the secondary market, or they are assets which mature within a short period of time. So which means you are able then to get that liquidity within the shortest period of time. So looking at then your current liabilities are your almost immediate obligations. These include payments that you need to make to your suppliers, which usually have a shorter term period, interest payments that you make to your bank. Now, the acid test ratio or the quick ratio basically takes all these cash and cash equivalents and divides this by the current liabilities. Now, the measure of the strength of your liquidity is based on any ratio that is above one, would indicate that you have the liquidity to meet your current liabilities within a short period of time. Now, the other ratio is what is referred to as current ratio. Current ratio is basically your current assets divided by your current liabilities. Now, the rule of thumb here is that you need to have more current assets than current liabilities, which means that you are able to convert these current assets into cash as quickly as possible. And this looks at both current assets and current liabilities that have a maturity of 12 months. Now, there is a rule of thumb in terms of what is the best or ideal ratio to have in terms of how many times of current assets should I have than current liabilities. So the common practice is to have 2 times more current assets than your current liabilities. And obviously it varies from industry to industry based on what you are dealing in or what you are dealing with. So in some industries, it is ideal to have 1.5 times more current assets than current liabilities, which means then you have a healthy liquidity position to be able to meet your obligations. Over to you, Beth.
So thank you, Davis. Thank you very much for that. At least then you've been able to share very quickly what does liquidity mean. And so when I move on now to the steps of managing liquidity, the first step for companies facing a cash flow strain is actually to get an accurate overview of their liquidity position. You have to figure out how much liquidity that you have and where it is. The second step then would be to come up with a list of actions that you can take up to improve liquidity. And on to the next slide, I'll be talking about some of those actions. The third point is that you need to consider the options in mind in terms of mapping out different scenarios. And some of these scenarios should be able to address questions such as, how long can we survive in the as-is situation with the current liquidity situation? No, the ideal scenario would give you a comfortable liquidity runway, and it's up to each company to decide how long that runway should be in this situation. The second point then becomes is how long will our cash position take us if we improve our liquidity situation? So this scenario has to be mapped out so that then you can be able to see how long will my business survive if we do A, B, C, D, E, F. The third point is that you need to forecast funding needs and to figure out how are you going to meet your funding requirements. And a word of caution here, because really in most of these actions, you'll find the first action that most businesses will take or focus on is cost cutting. The issue with cost cutting sometimes is that it carries hidden costs. And so then it makes it more difficult to ramp up again when the crisis ends. You will find that the businesses that have been able to stay afloat, albeit in a reduced manner, will be able to take on a higher market share if they're then able to open up faster than those that completely close shop. Finally, you will need to assess what you do need or don't need to pay and reprioritize accordingly. So when I move on to now the potential actions to boost liquidity, I have a couple of them, and it might not be exhaustive, but it may give you some indication of the things that you might want to consider in your business to improve your cash flow position. So the first thing here we are proposing is that you need to utilize installment-free periods from banks. I've come across a lot of business owners who are actually not aware that banks are giving installment-free periods up to 6 months. And so it is upon the business owners to come and negotiate with the bank to be able to get that reprieve to ease their cash flows. The second thing is that you need to look out for the government support packages. As we all know, the National Treasury is planning to create a 100 billion funding kitty to cushion distressed MSMEs via credit guarantee scheme that will ensure loan rates remain affordable and that also loans are available to medium and micro small enterprises. The third part that I wish that we consider is that if you have consultant packages, you might want to review if you still need them under these circumstances. And so there's an opportunity to terminate and probably bring them on when things are better. The fourth one is on software licenses. You will find because of reduced business, you might not need all the software licenses that you have. So it might be incumbent upon the business owners to just review the software licenses that they currently have because they carry costs with them. On to another point is that it is mission critical that you enter into a dialogue with your suppliers to negotiate extended repayment terms. And here the point and the guidance is, if you survive, they will likely benefit in your survival. Because if you close, then their business will be affected. And so it is critical that these engagements happen with suppliers to be able to negotiate the repayment period so that it's more comfortable. The other point, and I put it in red, because it is really at the heart of the management of this situation that we find ourselves in, which is communication. Communication with your stakeholders, your customers, and your staff. Now, I find that a lot of businesses, when COVID happened, they closed shop, and some of them opened, but they have not informed their customers that they are open. So what has happened is that the customers, or the businesses that are communicating frequently with their customers, they tend to get more business as opposed to the ones that shut down, opened up again, and did not communicate. I'll give an example of Java. Java is always sending messages saying, hey, you can come for breakfast, you can come for lunch. There are very few other eateries that have actually said they're open. So you find that you end up buying from Java. I'll move on to another point. And the point is around account receivables. This is a time where you need to manically review your account receivables because they could be a source of liquidity. And so that's a line and an income stream that requires a lot of focus now and into the future. We move on to dialogue with your creditors. And in this case, I talk about banks. Again, once again, you need to talk to your banks, and it's not just talking to your banks. You need to be able to demonstrate impact of COVID on your business so that then they can be able to alter the terms of your obligations. The point here and the guidance here is that you need to delay your payments as much as possible. Point number 9 is innovation. You have to think about new income streams. We cannot be stuck in the old ways. Sometimes this is the opportunity to hit the reset button and figure out what other ways and avenues and channels exist to be able to give my business income. Alternative funding is the next point. Now, funding could come by way of debt of equity. So as business owners, this is a moment to consider what options are available, what debt instruments are available to be able to keep the business afloat. Is it a time to be able to call on to the members to increase the equity? I don't know, but this could be an avenue. On point 11, the suggestion here is to convert your inventory into cash. So there's an opportunity to give higher discounts so that then you can be able to sell a bit more. This is not the point to get stuck at your prices. This is a point at which then you need to find a point where you can be able to turn your inventory to cash so that then you can keep your business afloat. Your distribution channel. We have observed that traditional distribution channels have become an issue, and especially now that we are operating on a low-touch economy where you have less contact with your customers. So you have to figure out, who do I partner with to be able to deliver my product to market? And so this is a point where people need to collaborate. The example that comes to my mind is what Twiga has done with Jumia, where distribution is happening through the Jumia platform. Now, there's a point around conserving and optimizing your cash position. And so here the point is you need to figure out various options, such as issuing bonus shares instead of paying cash dividends. We have seen that happen in one of the listed banks in the country. So go for a non-cash dividends option so that then you're able to completely conserve and optimize that which you have. The other one is about partnerships. This is a point at which people need to partner and collaborate for survival. And so we need to explore partnerships to help with the sustainability of your business. Again, the same example I had issued around Jumia and the B2B startup, agtech startup Twiga Foods, where they're delivering produce in Kenya using adaptive measures. I actually had them on radio yesterday where they were talking and inviting even more people to participate in this. And so this is a fine example of how partnership can be able to help with sustainability. Now, finally, you have to plan for when the crisis ends. And so if your liquidity position allows for it, this is the opportunity for you to be able to retrain, upskill your employees, and also just reorient them in terms of the roles that they have so that then the business is not completely at a halt. So plan for when the crisis comes to an end. So having said all these things, the question is then, what is SBM doing to be able to just support businesses with their cash flow position? And so I've broken it down into various verticals, solutions around the consumer business, solutions around the SME business, and solutions around the corporate business. So on the personal side, not even just the personal, across all the business verticals, SBM was able to send out letters to customers to just find out what we can do for them, and in addition to advise them of some solutions that may be available. And so I'll mention some of the solutions that exist. The first one being personal loans and credit cards. So what we're saying here is that we're able to issue loan repayment holidays for a period of 3 to 6 months. We are able to extend the loan repayment period up to 12 months. You may be able to pay interest only up to 6 months where principal is deferred. And then finally, for credit card holders, there's a repayment holiday for credit cards up to 6 months. On the business side, the first one, the most exciting, is our unsecured loans to SMEs of up to 5 million. That is 50,000 to 5 million is still up and running. Actually, in the last 1 month, we've been able to on-lend in excess of 100 million in this area. And so what we are saying to the community here is approach the bank and see whether you can benefit from this particular product. It is available for you. Secondly, we are able to tailor-make solutions for different sectors in response to COVID. The important thing here is to reach out to your relationship manager to explain how COVID has affected you and see how then your loans can be restructured. Suffice to say that loan restructures are not attracting restructure fees. And so this is an industry-wide issue, so that if you're banking with another bank, you be careful not to pay any restructure fees. We are also offering short-term overdrafts just to help businesses import finance on COVID-19 commodities. So where you have businesses that are actually importing COVID-19 commodities, we have a lot of attention to this particular type of business to be able to facilitate it by way of financing and offering very competitive terms. So that's on the business vertical. I move on to the third one, which is employee lending, otherwise known as workplace banking. And so here what we've done is that we have given a blanket loan repayment holiday for 3 months. So for the person earning, or for the person whose salary perhaps has been reduced by 50%, we are saying that you can get a loan repayment holiday up to 3 months with capitalization of interest. On to the fifth point, there's a lot of zero rating of charges on digital and online banking, where most of our consumer customers interact. And so this is something that you need to know and leverage on, because for the next 3 months, everything is zero rated. Now, we have facilitated and funded numerous learning sessions through webinars. And these sessions are very tone relevant, because then we want to equip our customers with the necessary knowledge to navigate this COVID period. So the trainings are two-pronged. We have trainings around business competencies, and we have training around soft skills. So what we've been able to deliver in the period that has passed, which is the last 2 months, through partnerships with the Passion Profit, is personal leadership training, training around profit literacy, and digital marketing. Digital marketing is one such topic that we have spent quite a bit of time on, and we shall be spending more time on in the month of May. Now, we've also partnered with Pinky, and we've held about 4 sessions, and the sessions have been around mental health, around finding purpose, and dealing with grief. The last session that we had this week was around understanding online learning and conscious parenting. And so all this material is available to just help the community that we live in deal with this COVID environment. The other point I want to mention is that SBM Bank has been able to open up its procurement area to be able to support women-owned businesses by applying a margin of preference. And so then we are very conscious to support women-owned businesses, to buy from them so that then they're still in business. Finally is a community development. So there has been quite a bit of community support. We have directly partnered with various community outreach groups by giving donations to various counties and to various companies. And so just recently, we were at New Life Home, where we were able to give a few things here and there just to assist. We were able to give donations to the county of Kisumu, the county of Machakos, and finally we were able to donate 1 million shillings worth of food packs to Shofco to fight the impact of COVID-19. So Minnie, if you could kindly just show the visuals even as we move along. So that's New Life. And the next slide, that's Kisumu County. The next slide, that is Machakos County. The next slide. Okay. I earlier mentioned about the trainings that we are offering in conjunction with our knowledge partner, Passion Profit. May 7th, we're able to have a webinar around understanding consumer behavior through data and insights. We invite you, AWEP members, to participate in the subsequent sessions. May 14th, we have a webinar around driving performance and productivity in times of crisis. May 21st, we have a webinar around utilizing virtual support services to increase productivity. And finally, on May 28th, we shall have a webinar around remote working tips and toolkits. Now, in closing, I have a couple of thoughts drawn from the various sessions I have attended, the reading that has come through. And the first one, and the most important for me, is that knowledge is power. You need to know the available credit and funding options that exist with your bank and look out for government stimulus programs. So that's the first thing. Secondly is around agility. And agility speaks to the ability of the business to develop continuity plans for operations and communicating this effectively to all the stakeholders. So this is critical. You need to build agility, capacity around agility. You need to be able to map out risk and develop ways to mitigate impact of the said risks. So the point here is agility. The third one is around adapting to the changing landscape. So what we're saying is that adaptability speaks to the business's ability to study the external environment and map out new opportunities. So the operative here is new business opportunities that could be explored. And associated with the new opportunities is the need to scan the external environment and monitor changes in the value chain and align with key value chain partners. I have mentioned a few examples and I have a few visuals that I'm going to share with you just to see how this is playing out. So again, here the critical word is key value chain partners. Identify who those are and collaborate with them for value and for sustainability. I have re-emphasized the point around planning for where the crisis ends, and I've said, do not lose the sight of the fact that this crisis will come to an end, and that businesses that are able to ramp up quickly are the ones that are going to be able to gain a much bigger market share. So here the persuasion is to keep the businesses going. I have a couple of visuals that I found very interesting. We have both local and international examples. And so here locally, somebody shared this with me, where White Rose Dry Cleaners Kenya has developed an app allowing home collection and delivery of clothes. I was sharing this example with somebody where my laundry shop closed down and forced me to move elsewhere. And when I moved elsewhere, I have not been able to go back. So again, here the guidance is to keep the business going and using alternative distribution channels just to make sure that your customers do not forget you. The other example I have is about a restaurant in Europe that has adopted the greenhouse model of serving customers. As you can see from this pictorial, this is a model that allows for social distancing, where customers are actually served out of these little greenhouses. Very beautiful pictures there. again, back to a local scene, and this I just came across in a WhatsApp group somewhere, is that our very own Big Square in Kenya has innovatively come up with a product where you can build your own pizza, and they sell you the ingredients and give you a how-to guide. So this is very popular amongst parents with younger kids. And so, I mean, some of these examples are just testament to the fact that you can be able to reorganize your business to make sure that you're relevant, you're exciting, and you're still out there and visible to your customer database. Now, there's a quote again by Bob that says, sometimes in order to be successful, a business must be reset. And so this is what is happening right now. Businesses must be reset. And so I will pause there and take it over back to Joy. Maybe she can share the questions that have been coming through, and I can also just respond to some of the questions that had come through earlier. Thank you very much.
Thank you very much, Ms. Beth Mudui, and also CPA Davis. Very, very, very detailed presentation. Thank you so much for sharing. And definitely we want to look at the questions that have been asked, and I'll just ask Minnie if you can just take us through some of the questions that have been received.
Hi, some of the questions that were received are, will you share the economic outlook from John Wekesa? What is the installment-free period? 0 interest on credit from Caroline. David Gandhi asked about installment only or interest and interest not to pay for 6 months. So I think we can go through them one by one. Or what do you think, Beth? Beth.
Hello. Yes, thank you for the questions. I was noting them down. And so to the first question around sharing the economic outline, this presentation will be available and will be hosted by yourselves and ourselves, so that then it can act as a reference point now and moving into the future. Now, there's a specific question around the installment-free period. And so what we are saying, this period ranges between 3 to 6, depending on your situation. What was the third question? I didn't quite hear it. Minnie, are you there?
I'm looking for it. I think it was installment only or interest and interest not to pay for 6 months. I think they're asking about the loan repayment periods, the extended loan repayment period.
Okay, Minnie, so again, we are able to give installment-free periods both on principal and interest depending on the situation, up to 6 months. So whilst I'm still here, allow me to just go through some of the other questions that had come through from the registered members that can be able to address a lot of the concerns that may be coming through. Now, there was a question that came through around negotiation on loan restructuring. And the question was, what is the best way of approaching it? Now, I need to mention that you need to demonstrate the impact on COVID on your business, so that then when you're negotiating with your bank, they're able to understand how this has affected you. And so then they can be able to restructure your loans. Now, I wanted to share the industry approach on this. The industry approach is that in order to alleviate the adverse effects of COVID-19, there are various emergency measures that will apply to borrowers whose loan repayments were up to date as at March 2nd, 2020. So the first thing is that banks will provide relief to personal loan borrowers based on the individual circumstances arising from the pandemic. So the relief on personal loans by banks will include reviews of requests from borrowers for extension of their loan for a period of up to 1 year. For MSMEs and corporate borrowers, they need to contact their banks for assessment and restructuring of their loans based on their respective circumstances arising from the pandemic. And finally, as I had earlier mentioned, is that banks will meet all the costs related to the extension of restructuring of loans. A couple of other questions that have come through. The question was, what are your plans for the MSME sector as far as access to credit is concerned. So I will speak to what SBM is doing. I want to reemphasize and reiterate the fact that we are able to give loans and unsecured loan facilities for amounts between 50,000 and 5 million. And in addition to that, we are investing in capacity building sessions through our knowledge partners. There was also another question around, if my company has a client on LC terms, can I access credit to finance the full order without the need of additional security? The answer is yes. And this can be done or solutioned through back-to-back arrangements. There was another question which I found very important. And the question is, how much liquid cash should one hold as a safety net during this period? So this really was a core of the discussion, and Davis is going to come in here. But let me just give a couple of comments before he comes in. The important thing, he spoke about ratios, is that you have to ensure that your cash ratio is greater than 1. So really you would need to take a sum of all your cash and cash equivalent assets and divide by your total liabilities. So this then would be able to show the number of times the short-term debt obligations can be covered by your cash and liquid assets. In summary, what I'm trying to say is that you will need to match your liquid assets with your current liabilities. And in this case, by way of definition, liquid assets are anything that you can easily convert into cash. So it could be your fixed deposit. It could be your T-bills expiring in 12 months. It could be your receivables. And so this is a comment I have around this area. I don't know, Davis, if there's anything else you'd like to add.
Yeah, thank you, Beth, for that. What I just wanted to add is basically just to look at your cash flow position from a point of all the activities that you undertake within your entities, from your operating activities, investment activities, and your financing activities. So as Beth has mentioned, in terms of your receivables, here the thing to look at is to ensure that you are able to collect your receivables as quickly as possible. If need be, offer bigger discounts where cash payments are being made. As much as possible, try to increase your payables in terms of what you need to pay out. So currently, in terms of payment of interest, which Beth has spoken through, speak to your bank to see whether you can now defer some of the payments that were coming due. I know the Kenya government is also looking at deferring some of the payments on the monies that it had borrowed from abroad. So as Beth has mentioned, in terms of these liquidity ratios, I mentioned the ideal position, and that is on a normal operating environment, is to have about 1.5 times of current assets compared to your current liabilities. I know this is not your typical operating environment amidst this COVID situation. So we'll definitely need to hold slightly more than 1.5 times, probably 2 times current assets compared to your current liabilities. However, there is inefficiency when we hold too much liquidity. Again, so there needs to be a balance there. So one needs to look at the operations of their various entities and look at what they are able to put in place to ensure that they have sufficient liquidity. Thank you. Over to you, Beth.
Thank you. Thank you very much. I've seen more questions coming through live. Allow me to just address one.
Yes, Beth, I was going to actually raise that. We had some more questions. Would you like me to read them through, or you've already captured that?
I've captured them. So let me start with the one that came in last. So the question was from Jimmy Malu. If I was given a reprieve for 2 months, can I extend it to another 4 months? The answer is yes, but you have to demonstrate the why, but the answer is yes. There was another question here. Will the recorded sessions be available to listen post this call? The answer is yes, and I'm sure Minnie will be able to just mention what platform this is available, and also the SBM team should be able to advise what platforms this is available. Now there's a question from Mr. Omar, what examples of procurement opportunities? Now we have over 60 categories of procurement opportunities within the bank. We just closed out the tender period sometime last year, and were able to just pre-qualify quite a few people onto the SBM platform. And so this we can take offline, so that then if you want to participate in the next session, I can be able to provide certain guidelines. There's a question here. Being in software development, some of our projects are stalled because we cannot commit to continue paying contracted developers, especially at the moment when we cannot predict when the situation is going to change. Question is, are banks still financing, and what will be the requirements? So here, the long and short of this is that we are assessing every situation with its own merit. And in the event that business is still continuing and that you're able to demonstrate cash flows, the answer is a strong yes. I also have another couple of questions that had come through earlier. Allow me just to go through them. What are the requirements of funding for cash flow at the moment? So here the answer is that the requirements have not changed for funding. You still need to provide your statements and financials. However, banks are a bit more cautious to lend in certain sectors, understandably so, in view of the economic effects of the pandemic. And so the other guidance here is that for restructured facilities, there is a requirement to demonstrate impact arising from the current pandemic. A lot of questions around accessing credit from SBM Bank. The answer is yes. I will hope that Mini, post this session, and SBM team, you'll be able to share contacts where customers would like to reach out for purposes of discussing credit. Now, there's a question I really liked. Somebody asked, what can I do to make sure perishable goods in my kiosk have a faster flow and still be profitable? And for me, the answer is channel, channel, channel. You need to consider alternative distribution channels. You need to consider delivering. You need to anticipate customer needs and reach out to secure orders. Deliver or partner with delivery companies to ensure that you keep your customers solutioned. Now, there was another question here. How possible is it to get into a credit agreement with a bank and a current apparel manufacturer in Kenya? And so again, the answer is that every application is reviewed based on its own merit. We are seeing a lot of activity around the apparel industry, and we'll be happy to engage further beyond this just to see what the opportunity is and what solutions you're looking for. Okay.
Maybe I can just add one question. Thank you very much, Ms. Beth. There's one question from Lorna Washira. She's saying, yes, loans are available, but sometimes the collateral is what is hard.
Yes.
Women hardly default on their loans. That's based on research. How can you factor this to suit them? Because most of what they own has joint names.
All right.
The questions around collateral.
Yeah, so that's a good question. Earlier on in my presentation, I did mention that just around the time COVID landed in Kenya, we launched our unsecured business loans. So women can leverage on these loans because then there is no collateral requirement for as long as you're able to demonstrate that you're running a viable business with steady flows of income. So they should be able to leverage on that existing facility that is available to both men and women.
Fantastic. And maybe just a last question, because I'm cognizant of the time, is SBM interested in startups at this uncertain times? And okay, I think financing, would the bank finance a business idea? Jimmy Malu is asking that.
Okay, so SBM is able to support businesses across their life cycle, from the point of startups to the point when they are able now to stand on their own feet. We have a sector under consumer banking whose main mandate is to be able to upskill and to be able to support and build capacity for businesses that are infancy. And for me, by way of definition, infancy is businesses that are less than 3 years. And so part of the things that we have done is building up capacity around delivering knowledge sessions. And as you go ahead with the knowledge sessions, you go through sessions such as profit literacy, you go through sessions such as making your business bankable, you go through sessions such as how to manage your cash flows. all leading up to the point that then you are credit ready. And so that is the long and short answer of that. We do not discriminate. We work with businesses across the entire bandwidth of their life cycle.
Fantastic. I think we've got all the questions captured, unless there's one very burning one that we need to address. Any last, maybe we can give room for one more question as we wrap this up.
There was someone who asked in the registration sheet if your banking services and loans are Sharia approved.
Yeah, the answer for that is no.
Okay, and there was one last one is, can you access this unsecured loans even if I don't have an account with SBM?
The answer is yes, and perhaps maybe I will request, and especially for the AWEB community, that you share the document I had shared that really speaks to what it takes for you to access unsecured loans. But in summary, for as long as your business has been in operation for the last 5 years, and you're able to bring statements from your bank, wherever it is that you bank, for the last 1 year, yes, you can access the loans. If not, if you're banking with SBM Bank, for as long as you've banked with SBM Bank for 1 year and your business has been in operation for at least 3 years, then you're eligible for the loans.
Okay, fantastic. I think we'll wrap it up now. Thank you so much, Ms. Beth Muthui, and also Mr. Davis Ayako. Thank you so much for the great insights that you've shared. I'll maybe just ask in terms of our next steps. Minnie, a lot of people are asking, how do they access this webinar? How are you going to get it?
So we'll post it. We'll post it on YouTube, Facebook, Twitter, Instagram, and Boomplay as a podcast. And we'll do so for the rest of our webinar series, because we have 2 more, one this week, one on Monday, and others planned for the rest of the month as well as other months. So you'll be able to find us on our normal social media platforms, and I will share on the group and via email for anyone who'd like to subscribe. We will share all the methods you can find the webinar. Thank you.
Okay. Ms. Beth, would you like, maybe do you have a particular contact they can reach out to from SBM? We'll share ours also.
Okay.
Anyone who's interested, we would like for many to open. If you don't have an account with SBM, who do they reach out to? There were questions around how do we access the unsecured loan and also the procurement opportunities. So maybe you can share who they can contact.
Okay, so the 2 names I will share here are Margaret and Abdia. I'll ask them before we end this session to just update their email addresses so that then there's somebody behind this conversation. So Abdia, kindly, if you can share your email address. Margaret, if you're in this session, you can share your email address, and I'm happy to share my email address. And I will type it out right now, but it is beth.mudhui@sbmbank.co.ke. I would be happy to personally respond to you and address whatever issues that you may have, so that then we can see how we can solution for it. So for me, here is a call for those who do not have a relationship with SBM to begin a relationship with SBM, so that then they can be able to learn some of the solutions that we have. And so feel free to reach out to me. Feel free to reach out to Abdia. Feel free to reach out to Margaret Kimani. Thank you very much.
Fantastic. Abdia, are you on the webinar? Maybe we can have you say something if you're not on the webinar.
Thank you, Joy. My email address is abdia.dabaso. Hello?
Yes, we can hear you.
It's abdia.dabaso@sbmbank.co.ke.
Thank you very much, Ms. Abdia, and we appreciate you being on the call. Thank you very much.
Thank you.
Ms. Margaret, are you on the call? Okay, great. So
Hi,
I think
Joy.
if you... Hi, Margaret, how are you? Would you like to say...
Good.
Yes.
Yeah,
Would you
just
like
to give
share
my
your
email.
address? Mm-hmm.
That's fine. It's margaret.kimani sbmbank.co.ke. And well done, guys. And welcome to SBM Bank, as Beth reiterated, and Davis. Thanks.
Fantastic. So, and also from the AWEB team, just to say thank you to everybody who's joined us. In case you have any questions, if you want to access the webinar recording or find out more about us, please send us an email to info@awebkenya.org. I know our chair lady is on the call. Maybe Madam Zora, would you like to say hello? And maybe give closing remarks? Not sure if she's still on. Okay, great. Maybe she's left the call. But thank you very much, everyone, for joining. We appreciate your time. We appreciate your contributions. As Minnie said, we do have more webinars coming up. For those of you who are women agripreneurs or youth, or you're in the agriculture space, we do have a webinar coming up on Monday, which I think will be of key interest for you to join. So please share with us your details and we'll be happy to send more information to you. So thank you very much and have a lovely rest of the day. Thank you very much.
Thank you, Madam Joy, for having us. Have a wonderful week ahead.
And thank you for the great presentation.
Asante.
Thank you, everyone. We've come to the end of the webinar. Stay with us for the rest. You can subscribe to the rest of our webinar series on info@awebkenya.org. We would love to hear from you. Goodbye.
Goodbye. Minnie, I noticed a lot of the participants would like the presentation. So if you could share their email addresses, we'd be happy to share it.
Okay, no problem.
Again, thank you, Madam Beth, for great insights shared. Thank you very much, Mr. Davis and the entire SBM team. We appreciate the great presentation. Thank you.
Asante.